Hello and welcome to my channel InfoCraze. Today we'll look into the exciting world of startup funding. If you are an aspiring entrepreneur or curious about startup funding, this video is for you. If you like this video, please subscribe to my channel so that you can get instant notification for my future videos. In this video, we'll explore the different stages of funding and provide valuable insights for beginners. So, let's get started. First, let's understand, what is startup funding? Startup funding refers to the process of raising capital to support the growth and development of a new business venture. There are various stages of startup funding, each typically corresponding to different phases of a startup's growth and development. These stages may vary, depending on the industry and the specific needs of the startup. Let us discuss the stages, which the process will generally include. First is pre-seed funding. This is the earliest stage of funding, where the startup is usually just an idea or a very early stage prototype. Funding at this stage often comes from the founder's personal savings, friends and family, or angel investors. This initial funding is often used to validate the business idea, conduct market research, and develop a prototype or minimum viable product. Next is seed funding. At this stage, the startup has typically developed a prototype or launched an initial version of its product or service. Seed funding helps the startup to further develop its product, build a team, and validate its market. It can come from angel investors, venture capital firms specializing in early-stage investments, or even crowdfunding platforms. Then, the startup will have Series A funding. This round comes after the seed stage, when the startup has achieved certain milestones, such as a viable product, user base, or revenue. At this stage, the startup has usually progressed beyond the initial idea or prototype phase and has demonstrated some level of market validation for its product or service. Series A funding is usually larger than seed funding and is aimed at scaling the business operations, expand its customer base, and execute its growth strategy. Venture capital firms are the primary investors at this stage, although angel investors and some seed funds might participate. Further, there are Series B, C, D and beyond. Series B, C and D funding rounds are subsequent rounds of financing that follow the Series A round in the life cycle of a startup. Each round represents a stage of growth and development for the company, and the funding obtained at each stage is used to achieve specific milestones and objectives. These rounds are aimed at further scaling the business, expanding into new markets, solidifying the company's position in the industry, and create long-term value for investors and stakeholders. Investors can include venture capital firms, private equity firms, corporate investors, hedge funds, or others. Finally, the company may go for an IPO. An IPO, or initial public offering, is the process by which a private company offers its shares to the public for the first time, allowing it to become a publicly traded company. IPOs typically occur when a company has reached a certain level of maturity or scale, and its growth prospects are attractive to public investors. Before conducting an IPO, a company undergoes extensive preparation. This involves hiring investment banks or underwriters to manage the IPO process, conducting due diligence, preparing financial statements, drafting a prospectus, and ensuring compliance with the regulatory requirements. This provides an opportunity for the company's early investors to realize returns on their investment and allows the company to raise additional capital by selling shares to public investors. Now, we may conclude that each stage of funding comes with its own set of challenges, opportunities, and considerations for entrepreneurs. Successful fundraising requires a compelling business proposition, a strong founding team, a clear growth strategy, and effective communication with investors. Additionally, startups need to be mindful of dilution, valuation, and the terms of investment agreements to ensure that they maintain control and maximize shareholder value as they progress through each funding round. Now, let's quickly glance through some important terms for startups. The first one is bootstrapping. In the context of startups and entrepreneurship, this refers to the method of building and growing a company through personal savings, or by the funds generated from the business itself, without relying on external funding or capital from investors. Bootstrapping requires founders to be resourceful and highly strategic in managing their finances and operations. It often involves starting small, focusing on generating revenue early on, and reinvesting profits back into the business for growth. Then we have angel investor. An angel investor is an individual who provides financial backing to startups or small businesses, typically in the exchange for ownership equity or convertible debt. Angel investors are often high net worth individuals who have keen interest in supporting early stage companies and potentially earning a return on their investment. Next term is venture capital. This refers to a form of private equity financing provided to early stage, high potential startups and small businesses with significant growth potential. Venture capital firms invest in these companies in exchange for equity ownership, typically taking an active role in their management and operations to help them grow and succeed. Next one is burn rate. This refers to the rate at which a company is spending its available capital or cash reserves over a specific period, typically measured on a monthly basis. It represents the rate at which a company is burning through its cash to cover operating expenses such as salaries, rent, marketing, research and development, and other overhead costs, without generating sufficient revenue to offset these expenses. Now, let's discuss the term convertible note. This is a type of short-term debt instrument, commonly used in early-stage financing rounds, which allows startups to raise capital from investors, with the understanding that the debt will be converted to equity at a later date, typically upon the occurrence of a specific event, such as a future equity financing round. The last term that we will discuss is exit strategy. An exit strategy is a plan formulated by business owners or investors to liquidate their investment in a company or to transition out of the business. Exit strategies are typically designed to provide a mechanism for investors to realize returns on their investment, often through a sale of the company or an initial public offering (IPO) of its shares. With this, we come to an end of this video. If you want me to add more details regarding startup funding, you may write the same in comments section so that I can provide you with further details. If you find this presentation useful, please do not forget to like my video and subscribe to my channel for many such interesting topics in future. Thank you.